What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, we're going to talk about something really cool. I think it's pretty awesome anyways. We're talking about how to set your kids up for life using dividend-paying whole life insurance. Because guys, these policies are absolutely incredible, especially when you set them up at a young age. And here's the thing, it doesn't even take a lot of money to create an enormous amount of financial security and a really strong financial foundation for your kids. It really doesn't take a lot. And I was inspired to make this video because we just submitted an application for a client that I'm working with. He's setting up a policy for his daughter. She's 3 years old. And man, when I was going through the illustration with him and his wife and just talking about all the things that this policy is going to do for their daughter and then their grandkids, great grandkids, it was really inspiring to me. And it was just such an honor and privilege to do this. And it really is going to set her up for life. So what I want to do is show you the real actual illustration that we submitted with the application, how I designed the policy, how it works, and then go through the journey I went through with the parents, just going through the different stages of life where the policy is going to serve their daughter. From buying her first car, maybe she's traveling abroad for school, goes to college, wants to start a family, buy a house, retirement, long-term care, all that stuff, because it paints a picture of how these policies can really serve your kids for their entire lives and really give them the financial foundation they need for pretty much anything, any emergencies that come up, large capital purchases, all these just major things that happen throughout the different stages of life, right? So let me go ahead and share my screen. I want to talk really quick about the policy design, and then we'll get into the numbers and all the benefits, how she can use the policy, et cetera, what it's going to do for her. So first thing we'll start with is the premium. So you notice here, $18,500 per year. Okay, so it's a little over $1,500 per month. You don't have to do that much. You can do less. You can do more. Just depends on your situation. But here's the thing: is he's not actually on the hook. The father is not on the hook for $18,500 per year. He's not going to get a bill from the life insurance company for that amount. He's on the hook for roughly about $6,800. That's the minimum. And then anything above that up into $18,500 is at his discretion to put into the policy. Okay. This is where policy design comes in. So the reason we're able to do that and create that flexibility is because we're putting a certain portion of the $18,500 towards the base premium that covers the base premium, that is. And then the rest goes into what's called paid up additions. I do more training on this in my channel and in my community if you want to check that out, but I'm just giving you a 30,000 foot overview of how we design the policy. The reason we would do that, one, it does create flexibility with that premium payment, just in case one year, he's not having a good year, his cash flows down, income's down, whatever. He's not going to get a huge bill of $18,000. But also with paid up additions, it accelerates the cash value, and in addition to growing the death benefit as well. So there's a lot of benefits to structuring a policy like that. The other thing that we did is we set up a pay to 95 policy. What that means is that the base premium, that $6,800, is going to be due until the age of 95. Now, there's a couple of things to break down there. One, the reason we did that is when he inevitably or eventually transfers ownership of the policy to his daughter, then she's now going to have a very efficient savings vehicle. So when she starts making money, she can start putting money away into the policy. Because again, guys, these are very, very efficient savings vehicles. That's why when people compare them to stock market returns and all that, it just doesn't make sense. You're comparing apples and tater tots, right? They're not even close to the same thing. These policies, very safe. They'll net 3 to 5% tax-free compound growth over the life of the policy, which might not sound like a lot, but when you see the numbers, when we start going, when she gets older, like the policy is older, these numbers are staggering, just mind-boggling, because the most important aspect or part of the compound growth equation is time. And we're talking 7, 8, 9 decades of time where, at 4 or 5%, it's compounding, uninterrupted, tax-free. Those numbers can get really big, okay? But just remember, these are very efficient savings vehicles. So when she gets older, she starts making money, she's now able to put her savings into this policy. So it sets her up to have a really good savings vehicle as well for life. All right. Let's see. Yeah, that's about it for policy design for now. Let's break down the first year here. Okay. So we're starting, she starts out with a $1.45 million death benefit. I don't want to overlook this. All right. Now you might be wondering, like, why are we really going to talk about death benefit when we're talking about a child policy here? Well, obviously, it's not likely anything's going to happen. But here's the thing is the death benefit really does help us prepare for the unexpected, because life does happen. And there's a story that I heard the other day. It's kind of why I'm bringing this up. Is there was a father, he had two kids. They developed heart failure, and the only reason that they were able to get the care that he wanted was because he had purchased a whole life policy on both kids, and was able to access a large portion of the death benefit early. It's called living benefits. If you're diagnosed with a chronic, critical, or terminal illness, you can actually access a large portion of the death benefit to get the care you need beyond what insurance will or will not cover, right? And it just gives you choice, right? It gives you options, and it gives you the financial resources when those unexpected things happen, right? So the death benefit is often overlooked, but it is a really, really important part of what we're doing here. So anyways, moving forward, let's go through the first major large capital purchase, I guess you would call it. Let's go to 16. All right. So at 16, she decides that she wants to buy a car. Now at this point, he's probably still he's going to own the policy still, the father that is, and she's the insured, and then him and his wife are the beneficiaries in case something were to happen to her. Okay. So he still owns the policy, which means he has control of this right here, the cash value column. Okay. So only the father is able to borrow against and utilize the cash value. So in this case, he would borrow against the cash value at 16 for her to purchase the vehicle. Okay. And look at this number already at 16 years old. We got $269,000 in cash value that they can access for whatever it is that she needs. In this particular example, we're talking about a car. Now you might be wondering though, well, why not go to a bank? Why not just pay cash? Because don't I have to pay interest on this policy loan? Yes, you do. But it's far more efficient to buy a vehicle with a policy than just cash or bank financing. All right. In like 99% of cases. I did a whole training on that. I will link it down below if you want more information on that. But the other reason, though, is that this is a really good teachable moment for his daughter, where he can start to actually demonstrate the power of what he has set up for her. And he can start to educate her and teach her to become a really good steward of this policy and to realize what she has. And that is essentially her own private family banking system here. That's how we can treat these policies. Is how I treat them through the infinite banking concept. But she has access. They have access to $269,000 for one of her first major life purchases. It's just so cool. I love it. Let's skip forward a couple of years to 18. What happens at 18? Well, a lot of times kids are ready to go to college, maybe travel abroad for a little bit. $328,000 in cash value here. And maybe at this point, he transfers ownership to her. Maybe he waits till 21, 25. Maybe he puts it in a trust. Like, he has a lot of options. And, you don't have to make a decision on what you do with the policy immediately. Like, you can do it whenever you're ready. Okay. But, at 18, when she, let's say she's ready to go to college, having access to $328,000 is pretty significant to help with college expenses. And, because college was pretty expensive. And for me, these policies, guys, are far superior savings vehicles for college than 529 plans. And I've done a video on that. I will link it down below. Please check that out. I'm not saying that 529 plans are necessarily bad, but it makes sense to me though, anyways, why we want to put our money in the most efficient vehicles possible. With 529 plans, you're talking about volatility of the market. So you're basically gambling the college fund there on the performance of the stock market. What if the market doesn't perform? Because you're not giving it enough time to really get the typical average of the stock market return the average return of the stock market. Because typically people are only funding them for 10, 15 years, give or take. That's not enough time. And then what happens if the market tanks when your kid is ready to go to college and ready to start making withdrawals from that account? Well, now the market's coming down, plus you're making withdrawals. It's not going to do anywhere near as much as you needed it to, or we're expecting it to, right? So for me, that's not worth it. This is far more efficient. We don't have to worry about stock market volatility. We don't have to worry about not having access to the money, and it can only be used for education with 529 plans. What if your kid decides not to go to college? What if they want to start a business, become a real estate investor, insurance agent? I don't know, whatever, right? Then you can't use the money for that. With a whole life insurance policy, you can use the cash value for whatever you want. You don't need to explain anything to anybody. So very significant amount of money available for college if she decides to do that. Not to mention, too, a lot of the times when people go to college, what happens when they graduate? Well, they're buried in student loan debt a lot of the time. Wouldn't it be nice to be in control of the repayment of that debt instead of being on the hook for a certain amount of money every single month? It just creates a lot more stress. It can potentially hurt your credits if you fall behind. It would just be nice to have a little bit of wiggle room. Not to mention also with your student loans, typically when you make those payments, always when you make those payments, that money's gone forever. It's never going to grow or earn interest for you ever again. When you make payments back into your life insurance policy from your policy loan, the principal immediately shows up in cash value, again, ready to be used. You can't do that when you make a regular student loan payment. That principal and interest is gone forever. But with a life insurance policy, when you borrow against it and you pay money back into it, that money shows back up in cash value, not the interest. The interest goes to the life insurance company. That's fine. It's a small price to pay to get true uninterrupted compound growth here, because in addition to restoring that cash value every single time she makes a payment back into it, this money grows uninterrupted because she borrowed the life insurance company's money. She didn't take her money out. All right. She borrowed against this. So her cash value continues to get that true uninterrupted compound growth. And you'll see what it turns into when she's 65, 70 years old. It's unbelievable. All right. So now we have a really good growth vehicle for college here. All right. Let's skip ahead a little bit more. Maybe at 25, we'll do 30 just to spread it out a little bit here. Maybe at 30, she's ready to settle down, start a family, buy a house. $810,000 of cash value available to purchase a house, or for the down payment is what I was trying to say. So she has access to that for a down payment on a house. Look at the death benefit she has too, $4.9 million that would go to her new family if something were to happen to her. And so her family would be taken care of financially. So she has the life insurance part of the equation of having a family here already taken care of, thanks to her father and her parents. I should say her parents. All right. But at 30, the other thing I was going to say too, let's say she's starting a family here. When you have this type of financial foundation in place, I don't know, for me, because I don't have kids, maybe in the future, it makes having kids so much, the decision that is, so much easier, less stressful, where you're not worried about money, because she already has an incredibly strong financial foundation here by the time she's ready to start a family. Maybe she starts a family at 25, $580,000 in cash value, $4.2 million in death benefit to protect her family financially if something happens to her. I don't know how you beat that. It's just a beautiful thing. Let's skip ahead to closer to retirement age. All right, so at 65, let's see where we're at 65. Look at it. This is where the numbers really start getting crazy here, guys. At 65 years old, let's say she's ready to retire. So here we are, total net cash value here. And I should mention too, this is the non-guaranteed column. Dividends with these policies are not guaranteed. All right, but here's the thing. This company has paid a dividend for 146 years straight. They've literally never missed a dividend payment, even throughout all of the chaos throughout the last 146 years. They've never missed a dividend payment to their policyholders. That's how strong these companies are. They're just, there's nothing like them in the world. They're the best risk management and just financially sound companies in the world. So I do want to point that out. All right, let's get back to the numbers here though. At 65, $4.8 million in cash value that she has access to for retirement if she wants. Guys, I don't know how anybody could say that is not an incredibly powerful thing. Like how much would she have to save on her own? How much risk would she have to take to build up a nest egg of $4.8 million that I'll remind you is tax-free? Okay. She'd probably have to save a lot. She'd probably have to take a pretty significant amount of risk in order to get anywhere close to that. But because her parents had the foresight and were thinking long-term, wanted to set their kids up for success and give them a really strong financial foundation for whatever they need, she has this $4.8 million that she can tap into a couple of different ways. One, by 65, this policy has now had 6 decades of uninterrupted tax-free compound growth. I invite you guys to go to a compound interest calculator, start playing around with some numbers and play around with the time. You'll notice that the longer these things are in place, the better and better and better it gets. Like the numbers just get crazy. All right, so a couple of different ways she can do this. At 65, it's had 6 decades of compound growth. Her dividend every year is probably pretty significant. And so what she could do is she could change her dividend from purchasing paid up additions, which is what it's set up as here. That's what gets the growth, grows the death benefit, grows the cash value, et cetera. But she can change that to paid in cash, where the life insurance company will actually send any dividends each year. They'll send her a check for that instead, and it's tax-free up to the basis. Basis meaning however much was put into the policy. So you can take your dividend payment in cash up to that amount, tax-free. Afterwards, your dividend would be taxed. But then if she hits that basis point, she could just change her dividend back to paid up additions and then take policy loans against her cash value here. Let's say she does that first option that I just said or explained for 15 years. And at age 80, she decides to start taking policy loans instead. It wouldn't be this exact number because the paid up additions would not be reinvested, or like the dividends would not be put back into the policy via paid up additions, but it would still be a pretty significant number that the policy still grew at. Because it's had so much time to grow already. So at age 80, she'll still have a significant amount of cash value for income that she could take, and just like the amount of death benefit she has at this point too, where if something were to happen to her, unfortunately, if she was diagnosed with a chronic, critical, or terminal illness, like I was explaining in that example earlier about the father with the 2 kids, she would be able to access a large portion of the death benefit here for her care. If she wanted to get alternative treatment or holistic treatment or had a specific facility that maybe insurance didn't cover, whatever it might be, she has choice. She has options there. So her parents are basically setting up her long-term care plan right with this policy, or at least a major part of it anyways. So really, really powerful stuff. And then, assuming that, God willing, she lives a very happy, long, fruitful life. And, people are living to be pretty old these days with advances in medical science and stuff like that. At 95 years old, look at this, guys. I mean, we're hovering around $15 million, give or take, depending on policy loans and how she's utilized the policy. But, we're talking about a death benefit into the 8 figures, potentially. That's generational wealth. I mean, that's setting up their grandkids, their great grandkids. This is just incredible when you give these policies enough time to do what they do. I mean, look at these numbers. I don't see how anybody could hate on this. Now, the final thing that I did want to talk about is you'll still see the premium due over here at $6,800 per year. So like I said, we set this policy up to be paid till 95, and then you'll see at 95, that's when the premium goes away. Okay. So here's the thing. She could make that premium payment, but at some point, probably not going to want to put money into it anymore. It's 75, 80 years old, whatever, probably set. Like, we don't need to be putting any more money into the policy. So what she could do is what's called a premium offset. So basically what happens is the growth of the policy covers the actual base premium. So let's say, for example, she received a $40,000 dividend. Part of that dividend would be used to cover the premium, and then the rest would be, if she did paid in cash or paid up additions, that's what it would be utilized for. So she doesn't technically have to make this premium payment every single year. And by the time this happens, so let's say at 75, she decides to do that. The policy, if we look at the policy growth here, it's growing by almost $300,000 per year. That can more than cover the base premium. I think she's good. So if at any point she didn't want to write a check for $6,800 anymore, she could just do a premium offset and keep all of her benefits with the policy. Obviously that would impact the illustration a little bit, but now we're talking about millions and millions of dollars of cash value and death benefit here. Like, it's just incredible. This like when I like I said, this is the first child policy that I put together. When I looked at the numbers here and just the potential of this, man, it's just mind-boggling. It really is, and just so powerful. And I think about like all the lives it can change. Not just for our kids, but thinking generations into the future. Not to mention also, too, guys. Most of us have organizations that we support. You see me wear that. Which direction do I do? This way. You see me wear this shirt on my content quite a bit. It's Operation Underground Railroad, and it's an organization I'm pretty passionate about supporting. And you can make charitable organizations beneficiaries on these policies. So imagine, she goes through life. She finds, her purpose, her mission, outside of like work and whatnot, or maybe they're one and the same. I don't know. But a cause that really resonates with her, she could put that cause as a beneficiary on this policy. And imagine when she passes away at 95, let's say, let's say it's $12 million, okay, instead of the 15 here. And she makes her, the charity of her choice, a 10% beneficiary, 20% beneficiary. I mean, we're talking about millions of dollars going to the charity of your choice, the organization of your choice, to impact thousands of people or animals, whatever it is that you're passionate about. Like, tell me how that is not incredibly powerful and just life-changing. These are the types of things that echo throughout eternity. One of my favorite quotes from Gladiator. But anyways, I'm going on a rant. I apologize, guys. I really love this stuff. These policies are just so powerful. And, I would have to say, I can confidently say that I think everybody should set one of these up for their kids. Again, even if it's only a couple $100 a month. I'm not trying to undermine that. Like, again, you see what these numbers can do. Like just a couple $100 a month can make a huge difference. So if you want to run some illustrations, if you want to see what that looks like for your situation, I'll have links down below where you can book a call. Let's have a conversation, see if it makes sense for you. It doesn't make sense for everybody. I get it. But if you think it might, then let's have a conversation and run some illustrations, look at some numbers and go from there. All right. Either way, I hope this was helpful. I hope this inspired you a little bit. If you have any questions, drop them down in the comment section below. I'd love to hear your feedback as well. What do you guys think about this? I think it's pretty cool. But either way, I hope you guys are crushing it, and I will talk to you in the next one. To your success, Matty Ice is out.